To build anything that truly lasts, it takes time.
We also welcome on board Anand Shah, CIO, PMS and AIF at ICICI Prudential AMC, joining us on the show right now. Hi Anand, good morning. Good to be speaking with you. Firstly, help us with your take on the markets overall, because off late, the Indian market seems to be consolidating. We are in the thick of the earnings, and this time there was indeed not much of an expectation. Other than that, it's the tariff announcement that the Indian markets are waiting. Help us understand, how are you sensing the pulse of the market right now?
Hi, very good morning. Yeah, I think market's been consolidating, but that's after a very sharp uptick in the markets over the last 4 months. So in that context, I think a consolidation is not a bad news. Look, the market actually peaked in October, and then it corrected very sharply all the way till the February end. When almost 80% of the small caps were down more than 30% from their all-time high. 60% of mid caps were down more than 30% from their individual 52-week highs. That sort of correction had happened, especially in small and mid caps. We have seen a nice sharp recovery in the markets. I think what is missing still for market to consistently do well is growth. I think the growth is a challenge. Top line growth, particularly for individual at aggregate level for the economy and for the markets, is fairly slow. We are finding some pockets of market where the earnings growth rate is still strong, but otherwise the demand, the growth is an issue.
All right, but Anand, talk to us about the pockets where you are finding a bit of a resilience, because of late, while we interact with the other experts as well, they are finding hard to find some good sectoral theme per se. Everybody is just looking out for some bottom-up stories. Is that the case with you as well?
Indeed, I think even within the sectors, there are winners and losers, and we can clearly see that. But the point is that the top line growth rate is fairly muted in general. So even when we are looking at consumption sector, even if you were to look at real estate, capex, private capex, government capex, even exports, everything is fairly soft. And to that extent, the top line is sort of challenged at an aggregate level, more or less, for most of the companies. I think that the bottom-up way of going is identifying pockets where there is a scope for margin expansion, there's a scope of consolidation. So we do have exposure to sectors like telecom and airline, which are getting fairly consolidated, and to that extent, on the margin, the pricing power is shifting towards the corporates versus the consumers. Separately, we are looking at metals, chemicals, even to some extent cement. Those are the sectors, again, while the top line can remain muted, there is a scope for margin improvement as global factors and local factors improve the pricing power and the profitability.
But Anand, that's interesting to note the fact that the tone of the market experts have actually changed quite a bit, because just 2 months back, or rather 2 to 3 months back, the banking in the financials was actually the consensus buy, but it's not the case right now. Why is that so? And given the fact that most of the fund houses still have that overweight stance on financials, and so is the FIIs, do you believe that banking as a pack will continue to be one of those preferred bets, or off late the shift is turning out to be in some of the other sectors which are yet to make a comeback, maybe consumption, maybe autos, or anything that is looking good to you?
So again, I'm repeating. So let me take banking first, and then we'll come to other sectors. That banking is very large and fairly resilient sector, as we see. And very clearly, corporates are not making mistakes. Banks are not making mistakes to that extent. the asset quality stress is fairly benign at this point of time. Having said that, the banks were beneficiaries of the rate hike. They had expansion of NIMs when the interest rates were moving up. There's no doubt in my mind that in this quarter, next quarter, and maybe one more quarter, we should have some NIM compression for the banks in general as the interest rate starts getting cut. So to that extent, while banks remain fairly valued on the margin, relatively better placed than the broader market in terms of valuations, but the growth would be a challenge for a couple of quarters to come. Obviously, RBI has done enough to push liquidity, and if the credit growth rate picks up, and I'm using the word if because that's not given that credit growth rate really pick up, because as I said, demand continues to remain an issue. The wage growth at aggregate level remains an issue. So neither corporates nor households are ready to lever up and start consuming. So that brings me to the next part of that. While the bank remains muted, it's okay. I mean, it's not fairly priced and a reasonable growth that you will get. The other parts of the economy, as I said, the wage growth is an issue. So if you want auto to pick up, you want consumption to pick up, I think what we need is wage growth, and that's something which is still missing. And as I said, it will happen either through exports. The global economy becomes, post the tariff issues becomes normalized, and the growth picks up on the exports front, or the domestic consumption boost we get either through budget or pre-budget. That's what I'm looking at.
Right, Anand, hi, this is Nehi also joining in. In fact, my next question was just on that, the kind of boost that we've seen from the budget towards the entire consumption side. But from your latest fact sheet, I understand you're slightly underweight on staples and you have select exposure to some consumer services. Could you help us understand what are you liking from that end of the market?
Yeah, as I said before, consumer services is more bottom up. We have seen fairly strong consolidation in sectors like telecom and airlines. Plus, we are seeing still robust growth in the services part of the consumption. So as the per capita income goes up at the top end of the per capita income, you will see increased spend in services over products, and that's where we are seeing fairly resilient demand for travel, for entertainment, for telecom services, for diagnostics, for insurance and asset management, so financial services in general. So we are seeing some pockets of growth within the consumption in services part of the consumption economy, and that's where we've been sort of more bottom up. But as I said, overall growth is muted, and we need to go more bottom up than top down, as we see.
All right, but Anand, just wanted to have your take on the middle pack overall, because there as a sector, I believe that you are overweight on, and that is one of those globally linked plays right now. Give us some sense that what makes you bullish on the metal pack overall.
Indeed, I think today the profitability in general, especially in the ferrous steels, remains fairly muted globally. We are seeing very strong exports coming out of China, which is putting a lot of pressure, not only in the profitability for the Chinese steel companies, but even the profitability for steel companies globally is under pressure as the China demands remains muted, but the production and the exports continue to remain strong. The whole premise on being overweight on select cyclical sectors is that we believe in pockets of chemicals, in pockets of metals, we will see bottoming out of the margin sooner or later. And that's when a little bit of pricing power comes back, a little bit of margin growth along with a reasonable top line growth will lead to, and the valuations again remains fairly attractive in these segments of the market relative to the overall market P multiple. So combination of a expected recovery in earnings and the reasonable valuations makes us more positive on this sector versus others.
Okay, and let's just focus from metals to pharma. That entire tariff overhang from Trump still continues to play on that sector. But amid the pharma space, you have healthcare, diagnostics, CDMO, so much happening within pharma as well. Overall, what's your stance on pharma, and if any sub-themes you're liking at the moment?
So again, we continue to be very bottom up in pharma because there are very different drivers of earnings and growth for each companies. So I think the outlook for US generics, notwithstanding the tariff related uncertainty, remains a little positive. I think we had a lot of pricing pressure which sort of eased, and that continues to remain fairly favorable for the generic companies in absence of a tariff issue. So I think we still remain on the sidelines. We're still watching out for what's happening on the tariff front and how the US generics is playing out, which is a large component of profitability for most of the pharma companies in India.
All right, but Anand, I remember that the last time we connected with you back in May, you were actually quite optimistic on the manufacturing theme overall, and that time you used to like defense and railways as a pack. And we have seen a fantastic run-up in these names of late. But do you believe now is the time where these stocks can take a bit of a breather in the short term and the long-term story and the growth trajectory continues?
So we've been sort of positive on manufacturing for quite a while now. I think we saw the bottoming out of the manufacturing margins in 2019, 2020 phase. And since then, there has been sharp recovery in profitability. But more importantly, as you rightly said, pocket of markets like defense and others have actually done extremely well. And to that extent, the valuations don't remain that attractive today in many of those pockets. So within manufacturing, and as I'm saying again and again, across markets, you'll have to be more bottom up. I think broadly market is fairly priced, and to that extent, there are not outsized returns you can expect from the broader market. And from here on, for creating alpha on the way up as well as protecting the capital in event of a sharp correction in the market, I think being more bottom up, being more focused on the earnings growth rate at a reasonable price, reasonable valuations, both are very important, and we continue to focus on those areas, identifying sectors and companies where earnings growth relative to the valuations are attractive today.
Okay, and Anand, let's talk about a sector where we've seen a lot of big moves happening recently, lots of price competition, and that's the entire paint space. Do you have any weightage on the paint space, if at all? What's your view going ahead, and select stocks if you're liking at the moment?
So again, one of the very big themes for us has been consolidation versus fragmentation. I think in our bottom-up stock picking, it's very important to see which sectors or which segments of the market where the number of players are reducing. There is a consolidation, and to that extent, the pricing power is moving back to the manufacturer or to the service provider. And that's where I've spoken about railways, airlines and telecom sector in general before. In that context, I think the consumer space in general and paints in particular have had a very high profitability for a very long period of time. We had a fairly stable competitive intensity where 4 players dominated that market. Since then, there has been, given that the valuations were reasonably high for this sector, market was ready to value them in greater multiples to their earnings. It has attracted a lot of competition. So we've seen influx of quite a few players in that segment of market, particularly in paints, over last few years, and that has sort of brought down the growth for individual companies, but also the margins. So I think we are yet watching that space and seeing if there is an end of competition, and we'll again start seeing consolidation, start seeing HHI moving up, and that should help the sector and the companies in those sectors.
But Anand, does the same theory hold for the cement pack as well? Because there too we have seen a lot of consolidation, a lot of big players entering, and of late some reports are also highlighting that the pricing power seems to be coming back, though on a month-on-month basis that keeps changing. And you have been bullish there too. But the question is that cement as a sector within the players, it's quite regionally divided. How do you analyze this particular trend and any particular pocket that is looking interesting to you right now?
So again, cement is got consolidated not only last few years but over last 20 years, and at a region level it is further consolidated. So yeah, having said that, I think what we like in the cement sector is that the profits are not very high. The margins relative to the historically what they made is not significantly higher, and to that extent, we believe the cement has a room for prices to move up, for margins to move up, given that the inflation has not been very high in that segment of the market for a very long period of time. Within overall, I think one pocket remains is the southern India, where margins were far lower than the average, and that's where we are again seeing some bit of uptick. But otherwise, generally across India, we expect that consolidation should drive slowly and steadily the profitability on the higher levels as demand picks up. I think demand will be the key, spending on real estate, spending on housing, spending on infrastructure. I think without that, we will not get a sustainable improvement in pricing and profitability. As you rightly said, that month on month that changes. The reason being that demand is not as strong as one would want for a sustainable growth in improvement in pricing and the margins for the sector.
Right, Anand. Thank you so much for joining us. Great chatting with you today. Thanks once again for giving us your time on ET Now.
My pleasure. Thank you.
Thank you. Let's move away from that and talk about a stock that's doing very well in trade today despite posting a weakish set of quarter one numbers. That's Tata Com,